Hello, this is Aaron Rosen, your local realtor in Northern California. Today, we actually just got the California housing market update. These are some stats that are produced by the California Association of Realtors and released every month. And it just gives you some information about the market. So I was just going to go through this with you and see what we can glean as useful information. So right off the bat, as California as a whole, there were 270,000 home sales in the month of June, which is a 2.7% drop year over year. The median house price, 900,000, which is 7.5% up from this time last year. You know, that's getting to be quite a lot. I remember just a little while ago it was 800,000. I'm not sure exactly when, but that's moving up quite a bit, really fast. We've also got 3 months of inventory, so this says that there's a lot of different houses that are on the market right now, which is great. So if you're a buyer, you can take your pick. And median days on the market is 18. That's still quite low, even though it's 20% up from last year. So 18 days on the market's pretty good. If you're thinking about selling or buying, it's actually not a bad time for each. You know, if you're going to be selling, you have a lot of competition, so you probably want to be pricing aggressively. And then from here, it breaks it down a little more into various regions. You can see that Southern California home sales are down 11.5% from last year, which is huge. That's the housing market. It's a lumbering beast. So any dramatic moves like this is, that's quite volatile. That's not usually, that's not typical here. Sales price to list ratio, people are getting 100%, 20 days. So it's on the market a little bit longer than an average. Coastal down less year to year, but year to date it's actually up. So you can see that there's different markets here, and they have kind of different ways in which they fluctuate. So this one, 875 for SoCal. And then kind of in the central coastal area here, it's actually 1 million, which makes sense because there's less people in this area here. In LA, they have a lot of houses. And houses were selling for 100% of their sales to list price ratio, the same as Southern California. Central Valley, an entirely different beast. You can see here that they actually have had less home depreciation than the other places, and their existing home price is 500,000. So not only is this a smaller percentage, it's smaller of the total amount as well. 17 days on market and also 100%. So just looking at these, even in the first 3 slides, what information can we glean? The Central Valley is going to be the best deal. Now, will this catch up to some of the other areas? There's a lot of factors that depend on that. There are some good investments areas out here, but this is mostly going to be farmland in here until you kind of get over into the mountains there a little more. All right, this is where I am, the Bay Area. The Bay Area has lost the least in the year to year, and year to date, it's actually come up 6%. Unsold inventory is 2 months. Median days on the market is 14. So this market is hotter. The San Francisco Bay Area is doing better from a metric standpoint, and it's selling for 102% of listing price. That's 1.4 million. So it's actually way more expensive, almost triple as the Valley, and it's selling for 2.4% over listing price. I've seen a lot of information come out of the Bay Area about how their prices have come down a lot in the last 2 years, but it's also rebounded quite well. So far, had you been investing in one of these 3 areas, the Bay Area would have been the best so far. Okay, far north, even though they kind of skipped a region in here, I'm not sure if they have it. Wow, the far north. This is the forgotten part of California. 16% year to year, and this is the only one, I believe, that was actually down year to date. That's amazing. Unsold inventory is 5.4 months, which is way more than the other ones, and it has higher days on the market. And this is the only area in California where you are not receiving 100% or more of your listing price. That makes sense. There's sparsely populated up here. I actually have a land listing way up there, and I also have one in the Bay Area here. And just as a note, I've gotten 2 or 3 calls about this one up here and maybe 50 calls about this one here. So that just shows you the discrepancy between these two. Will these even out? Yeah, we could explore that idea. Okay, let's go into sales. Sales yank further back due to mortgage rate volatility. So you can see here that it's normally hovering around 400,000, kind of in this range here. And then during the financial crisis of 2007, 2008, home sales, they went from triple at a high of 600,000 down to about 200,000 and then rebounded here to 400,000. Now, we didn't have the same financial crash as we did, but we did have COVID events. And, this period here was low interest rates. And then when they raised it, it just went off a cliff here. So now, this is actually the first time, you see how fast that this is rebounded in a V shape right here. Here's your V down, where's your V up? So this is actually really interesting in that while we are having a fair number of homes that are turning over very quickly, home sales are still depressed compared to historic standards. That's interesting. So we're going to see if this is going to come back up in the second half of this year. And, the Fed says that they're going to lower rates a little bit. That'll tick it up. But realistically, we need to bring the Fed's fund rate down from 5.5% down to more about 3.5% before we're going to see home sales back up to this area here. Now, the interesting part is that the prices of homes do not match this curve. So even though home sales are depressed, we still have relatively high prices. And during this financial crisis back here, home sales and home prices tracked more closely. So we're actually having an interesting divergence between home sales and home price, which is the first time in almost 20 years here. So that's actually a little bit of strategy. If you were to buy a house right now and then wait for interest rates to go down, housing prices will shoot up as they bring interest rates down. Year over year sales. See, here's the depression. That was that huge spike right here, even though it's more pronounced on the way they have graphed this one. So we are coming up to just about historical average of year over year change in home sales. The Bay Area has done the same thing, except that it is holding up a little better. Instead of 2.7%, it is 1.7%. Look at this. SoCal home sales slipped further below last year. This is down 11%. So this really shows to me that the home sales in Southern California are struggling. It is not nearly as healthy as a market as the Bay Area. Can there be some advantage taken in that situation? Absolutely. When there's less home sales and the market's not doing very well, there's going to be more people who are not receiving the amount of money that they'd like, and then that's when you can hunt for a deal. Central Valley sales, that's kind of in the middle of these two. It's not the whopping 11% down like the other one, but it's definitely more than the 1% and the 2% there. Okay, June 2024 sales by region. So you can see Southern California is dominating this, but Southern California dominates the population. I would be interested to see, though, because this is not a equal representation of the population to home sales. So, California, probably more than 43% live in Southern California. Yet it's only 43% of the home sales. So I can guarantee you that the San Francisco Bay Area is not 23% of the population. However, the home sales are 23% up. So what that shows me is that there's a lot of cycling of houses in the Bay Area. There's a lot of people buying new houses, and there's a lot of people cashing out on houses that they've had for a long time. So that's pretty interesting. And the Central Valley, it's been swooped up. There, it's half the price. We saw that it's 500,000 instead of 1 million or 1.4, million for the Bay Area. So this is actually a really surprising statistic as to why the Central Valley is doing what it's doing in the market. There are a lot of home sales there, and that can partially be to working from home. There's lots of different reasons as to why that'll be. Okay, moving on. Sales at the top end of the market still advancing, albeit at a slower pace than the previous month. Okay, so this is 1,023,000. That's 2023 was 33%, and now it is 36%. So the luxury market's a little different than the regular market, and you can see here that it's slowing a little bit. There was a huge rush for luxury property around the Bay Area. Right now, I actually looked yesterday, there's over 250 homes listed for over $10 million in just Northern California. So that just gives you an idea. You know, there's maybe 5,000 or 7,000 homes listed in Northern California, and 250 of them are above 10 million. So just kind of shows you how the market is diverging there. All right, sales growth. Sales growth at the top price segments moderated. So let's see what this brown line is, because that's going to be the most. Oh, wow. Okay, so this is for $2 million homes. You can actually see that they have done better. Change in sales. Is this sale percentage? Percent change in sales. It doesn't say sale price. It appears to be sales in volume. So what this shows you is that during the 2020 to 2021 COVID experience, there was a huge increase in luxury houses. You can see that there was a 300% sale, and you know what? The price reflected that. And what this says to me is that the luxury market is not about homes, it's actually about investments. And there's a number of articles I've been seeing about celebrities selling their houses recently. So this right here will turn your $7 million house into a $13 million house or whatever it is. And that's very, very tempting. And we can see as we've come over and the COVID died off, that even after we came into this lull here, the luxury homes are still what is being sold the most relative to their proportionality. Sales growth at top price segments moderated. This is basically the same graph, just shown in a different way. And you can see that again, the 2 million plus homes are leading the charts here. Now, this also has to do a little bit with the number of sales. So for example, Southern California has cooled off as a market, but San Francisco was taking, I believe it was 23% of sales, and San Francisco has very expensive houses. So that's going to be why that this is pushed up. So $2 million in San Francisco is not really a luxury place. It's got to be more like a $3, $4, $5, $6 million place before you get luxury. $2 million in San Francisco, it'll get you a nice house, but it will not be considered luxury by, let's say, Sacramento or Texas standards or Central Valley, or even in Sonoma County here. $2 million house here in Sonoma will be grand. It'll be beautiful. You'll get a lot of land, and that will probably not be the case in San Francisco. Mix of sale change continued to support median price growth. You can see here that they're oscillating between these. So these are cheaper homes and homes above a million. And you can see that percentage of sales that it kind of oscillates back and forth here. So this was the COVID area. All of those cheap houses got bought up. There was really, really cheap loans, and so a lot of that got converted into Airbnbs and vacation rentals and just regular rentals as well. And then after that, you can see that luxury has become a bit more of an investment for people. So this kind of goes in waves. More typically, that the lower end is bought in more cash, and then the luxury is bought not in cash. And one of the simple reasons for that is, well, there's two main reasons. One is going to be that cheaper houses are obviously cheaper, and it's easier to come up with $500,000 versus $1 million in cash. The other thing is, if you are buying a more expensive home, the chances are is that you have better credit, and that can actually lower the amount that you pay total back. So it oscillates between these. Pending sales just shows you basically just hovering here. There's a lot of volatility in here. Home sales could improve in July. Average pending working day. Okay, so let's just take a peek here. So we've kind of got this pattern here. It's a little bit of like a head and shoulders pattern from stocks. So May, June, I'm not sure why June is not in here. April, May. So this one goes to April and this one goes to May. Some of these graphs I don't think are super useful. Pending sales, let's just kind of move on from this. This is the same graph as before, showing that luxury has picked up more relative to some of the others. Pending sales compared to previous month. You can see this jagged pattern here. So, we're at the bottom here, right? So it's a good time to buy, not such a good time to sell. But in the next month or 2 months for the rest of the year here, it'll probably trend upward, and those two will reverse. Okay, let's check price here. And this is what I was talking about. I may scroll up to the other one, but you can see here that after the 2008 financial crisis, it's funny that they call it that when it actually started in 2007, but prices went way down. So we had the same thing, prices went down, but they did not go down nearly the same amount. And home sales, home sales took a big dip, and then they did that V up I was talking about. Here, they did not do that V up, but we're still at all-time record prices. So to me, that says as soon as interest gets lowered, this is going to shoot up even more. And for some reason, if interest does not get lowered, which they are expecting, we still have further downside to this, because it has not actually had the same kind of correction that there was in the financial crisis. Now, these aren't the same. This was a subprime crisis, and over here it was a COVID crisis. So they're not directly going to be the same in like a 1-to-1 ratio in their effects on the market. However, the price and credit are still in the high effect here. So it's been a little bit different in the entire market. Condo townhome median price. This just basically the same graph, just for condos. You can see that condos became very popular when people ran out of money for regular houses. Price growth advance for condos and single family homes. This is a % year-over-year change. Basically, they're tracking the same. I do expect there to be a little bit of a divergence between these, because in Santa Rosa, we have an extreme amount of new construction here. We had a fire north in Fountain Grove, and so they rebuilt all of those homes, but that process has basically run its course. So after that, there really wasn't a lot of open and vacant land, and there was a lot of projects coming up for new apartments and for condos. So I'm going to be keeping an eye on this over the next few months, and I expect these two to diverge a little bit as they've done over here. You can see that condos actually suffered more during this period, but they also had a higher rebound. So, which wasn't the case over here. You can see that the market is kind of shifted for condos. Median price growth by percentile. Not so interesting. Okay, price per square foot. Your average is going to be right around 400, maybe a little more, which is interesting. Here in Santa Rosa, it's going to be a little higher. It's going to be about 500 to 7, depending on your area. And in San Francisco, during the height, it was up to 1,000, and now it's down to about 900. Just go on from this one. Okay, see, this is what I was talking about in the difference between the square foot gap between home types inched up. You can see that condos are actually more expensive per square foot, which is a little bit odd to me, but you also do get more amenities. So, for example, if you have a condo and it's got a pool and all these other amenities and a parks that I've seen in some of them, then they are going to charge you for that. Sales to price list ratio unchanged. Basically flat. This is what we saw in the beginning of this, is that it's at 100%. People are getting what they are asking for as long as you price it in the market, which is actually really good. So if you're looking to sell a house, I can get you 100% of what you're asking for it, provided that you are asking a reasonable price. Here you can see, this went up to 104 and down to 98. It depends on segments of the market, but this is let's just say from 95 to 103. This is an 8% difference. So, on $1 million, that's 80,000, which is significant, and that's a difference. So, theoretically, from August to February, you could have made an additional 4% or $40,000 on your house had you decided to list it here rather than there. Share of homes sold above asking fell to 3-month low. 1, 2, 3. We're in a bit of a downward trend here. So this data is a little confusing because according to this, if we're in a downward trend of the homes sold above asking, then this actually should have been above that. So, a lot of this depends on how you slice the cake, and there's a lot of differences between the various counties. Okay, this is a great graph. So, just as a note, if you live in any of these counties and you want to sell your house, then that's great. If you live in any of these counties and you want to sell your house, then it's actually not so good. You have to be careful about how much you're asking for. Excuse me again. So this is Alameda, Santa Clara, San Francisco, San Mateo, Contra Costa, and Los Angeles and Ventura County and Orange County. So while there has not been a lot of sales in Southern California, they have been selling for over asking. And that makes a lot of sense because if there's not a lot of inventory, well, you're going to need to basically you can ask more because there's going to be more buyers chasing fewer homes. Okay, list price versus sale price. You can see that what this shows, and this is actually really interesting, the disconnect between sellers and buyers. See how the expectations of buyers and sellers, it doesn't match up. You can see that during COVID, everybody said, I want a high price for my house. I'm going to do it. I want a high price. And people said, you know what? I'm not really going to pay. I'm not going to pay. And then they said, you know what? I will pay that high price. And then as soon as it did, as soon as people started paying that high price, people started saying, oh, my house isn't going to be worth that much. And they listed it for less money. To me, this just shows an incredible loss of opportunity, because if I was a home seller and I noticed that people were paying what people were asking for 30%, 30% over, then I would be like, no, we are listing at this price. The only problem is that everybody decided, no, I want my house sold now. So this is one of the challenges of being a real estate agent, is connecting the expectations of the buyer and the seller. So sometimes if a buyer says, if this is a buyer's expectation of where price should be, and this is a seller's, well, you have to converge these two as a real estate agent. And there's a number of ways to do that, including concessions, rent backs, buy downs, all sorts of things. Again, price growth by percentile, California market velocity and price growth. This is interesting. So we're coming back. See, everybody here, when interest rates came up, everybody said, I'm not buying a house. And then necessity kicks in. You get married, you have some kids, and you say, you know what? I'm going to refinance. So people started buying houses again. Okay, mortgage rates remain elevated, and so is the cost of borrowing. We are at 6.92, which if you have great credit, we can get that down a bit more. So California median price versus mortgage payment. Mortgage payment growth. So what happens is, as they raise the rates, the price growth comes down. So what do you expect to happen now? You see how these two came back and touched here? Well, they're almost touching. That's the exact same situation that we had over here. When these touch, we're going to have huge price growth as mortgage payments decrease. The general rule is, for every 1 point you lower the interest, it's between 11 to 15% more house that you can buy. It's compounding interest, so it's not a linear progression. Mortgage payment growth remains elevated. This is showing the same thing as the last graph. Okay, inventory and active listings, which we've covered somewhat. Inventory constraints remain the biggest challenge in the market. Did you hear that? That's really interesting. So if you want to sell a house right now, there's actually a lot of houses for sale. Not compared to historically, but in the last few months we've had a tick up here. But it's still suppressed from that 400,000 down to around 250,000. Unsold inventory inches up. You can see that things are sitting for slightly longer on the market than they were. Just going to skip that one. All right, total active listings have been on a rise trend since January. Let's see the way this is broken up here. Active listings by month. So there's around 50,000 listings per month in 21 and 2022. And then you can see down in 23 and 24 that we are in a suppressed area there. This is the same thing. So you can also see that this has a seasonality to it, right? July, it pops up. July, it pops up. July, it pops up. So when is a good time to sell your home? July. Sell your home in July. When's a good time to buy a home? January. Buy your home in January. January. April, in the first 3 months of the year. January. Sell in July. Buy in January. Active listings. We already kind of covered this. Housing supply conditions to continue to improve from 2023. Average new active working day. Average new working day existing family home sales. You can see the same cyclical pattern here, right? So unless you absolutely have to buy during one of these periods, you should be waiting. You can see this is the same cyclical. It's the exact same. It tends to show things in a couple of different ways. I'll probably condense this next time. We're coming up on 30 minutes here. But hopefully you've learned something about the California market, because this is the kind of thing that I use for my clients when they say, is it a good time to sell? Well, I make a report and I say, well, there's a lot of home sales right now. Are you expecting 100% of listing price? Are you expecting more per square foot than the average? So you may have a nicer home, and let's just pretend the average price per square foot is 500 and you want 510. Well, if you're doing that in the wrong time of year, if you're doing that in January versus July, you're going to have a difference. So literally waiting a half a year will basically get you that extra 10% in price per square foot. Active listings by region. Southern California obviously has the most people in there, but do you think that Southern California has 3 times the population that San Francisco does? No, it has a lot more than that. San Francisco, last I checked, it was around 900,000. There are more people in the Bay Area. Oh, so this is San Francisco Bay Area. So we're just going to say there's 3 million here. There are way more than 9 million people in Southern California. So proportional, San Francisco is a much better market. Everything's ticking up across the board. Housing supply increase in all but 3 counties in the state. Wow. Active listings. So you can see Alameda, Contra Costa, these are the same ones. There's a huge number of listings, and if you're in one of these counties, you're going to have a much easier time to sell your house. This is amazing to me. In Glenn County and San Francisco. San Francisco was such a hot market. So look at this. San Francisco proportionally, let me just go up, proportionally according to its population is astronomical. Southern California, maybe it's got 20 million people or more than that, but it's got 15,000 sales for, let's just say, 20 million people, and San Francisco has 5,000 sales for 3 million people. So this, if it's down 23%, that means that San Francisco actually had about 7,000 sales. So that just shows that San Francisco has actually been hit really hard. Time on market is inching back up, but we are actually at a low. If you are interested in selling your home fast, now's a good time, but you may not get the best price for it depending on what county you're in. So really, what we do as real estate agents is we kind of factor all of these different things together. Oh, you're in this county. Well, home sales are actually relatively low, but prices are high. So if you'd like to know how we do a comparative analysis, which I actually think I will do, I use all of these current graphs to help influence how I determine someone's price. Okay, sales to list price ratio by percentage. Look at this, across the board, basically everyone's getting 100%, except for this percentile, which is going to be, this is the 96. The top end of the market, people are not getting as much, but that is because it went way up, and the luxury house market had gone absolutely crazy. So the luxury house market is far more volatile than residential. And this does not include commercial sales. If this was commercial sales, the graphs would be up and down 30 or 40 or 50%. List price growth for $1 million properties. Listing price, sales price. You can see here that they have high expectations, right? In the last year and a half, 18 months basically, the luxury sales, market has had a huge expectation. And the reason is the stock market. In the last year and a half, the stock market has gone up. The stock market, in my experience and opinion, is more tied to luxury sales. That's somebody who has, $8 million in Apple and takes out a loan against it so that they can do a $5 million luxury place that's a second home, that's an investment. And they got clobbered. Basically, they said, "Oh, I want all this money for my investments," and it just didn't happen. Okay, now this is fun. Reduced price listings. Share of listings with a reduced price. 33% of median reduction. Okay, so share reduced and median reduction. You can see that it's about 10%, 45, let's just say 40, we can kind of average here and say 35% of sales had to lower their price by around 7%, which is amazing. Yesterday I was actually looking, yesterday there was 570 homes new on the market in the Bay Area and 380 price reductions. So a lot of this is going to be about expectations. Okay, well that was the last slide there. So I hope you learned something. This is just something that I peek at. It comes out every month, and it just helps me to understand where the different markets are in California and how they're relating to each other. If one of them gets way too expensive, people just leave and go to a different market. They chase jobs. There's a lot of socio-economic, political things that happen. Central California isn't necessarily the same politics as San Francisco. They have different concerns, they have different needs, they have different zoning, they have different regulations, all that type of stuff. San Francisco right now, they are building a lot of low-income housing, which will definitely change this. Biden also just did the other day where he's putting a cap on places with over 50 units can only raise rent 5%. Now, whether or not that's a good thing is another discussion, but the end result for renters is they will have more money in their pockets over the next number of years. Now, this may backfire in a certain way because people might just start charging more to when you move in. They may have a higher turnover rate, and that'll allow them to charge more. So we'll see how that plays out. But these are factors that I'm always keeping an eye on. And if you need any information, or you'd like a comparative market analysis for your house, or you'd like to understand where the best places are to invest in California, all my information is below. Feel free to reach out with any questions. Okay, thank you very much. Have a good day.